Welcome to Introduction to Business. We're going to be looking at Chapter 15, Money and the Financial System. The learning objectives include define money, its functions, and its characteristics, describe various types of money, specify how the Federal Reserve Board manages the money supply and regulates the American banking system, compare and contrast commercial banks, savings and loan associations, credit unions, and mutual savings banks. Distinguish among non-banking institutions such as insurance companies, pension funds, mutual funds, and financial companies. Analyze the challenges ahead for the banking industry. Finance is the study of money, how it's made, how it's lost, and how it's managed. Money or currency is anything generally accepted in the exchange for goods and services. Many things have served as money, such as salt, cattle, and precious metals. Most of these materials were limited supply commodities that had their own value in society. IOUs are slips of paper that could be exchanged for a specified supply of the underlying commodity developed later. Finally, fiat money is paper money, not readily convertible to precious metals such as gold. It did not gain full acceptance until the 1930s. Money serves as a medium of exchange, making it easier for people to buy and sell goods and services and reducing the need for barter, which is the trading of one product or service for another of similar value. Bartering was inefficient because it was not always divisible and can be complicated in a multi-party transaction. Money serves as a measure of value or common standard for value of all goods and services. Money acts as a store of value or as a way to maintain the value accumulated wealth until it's needed to purchase goods or services. Unfortunately, the value of stored money is directly dependent on the health of the economy. Inflation and deflation are both problematic for the economy as well. Characteristics of money include acceptability. To be effective, money must be readily acceptable as a way to pay for goods and services and to settle debts. Acceptability is probably the most important characteristic of money. People must believe in and trust the value of what they use as money. Divisibility is to facilitate exchanges. Money must be easily divided into smaller units of value. Portability, for money to function as a medium of exchange, it must be easily moved and carried. For most societies, paper money and metal coins satisfy this need. Stability, money must be stable and maintain its declared face value. Stability allows people who wish to postpone purchase and save their money to do so without fear that it will decline in value as during periods of inflation. Instability destroys confidence in the nation's money and it will ultimately lose acceptability. Durability, because its continuous use, money must be durable in order to maintain stability and acceptability. Difficulty to counterfeit, money must be difficult to duplicate illegally in order to maintain stability and acceptability. Because modern technology makes it easy to counterfeit paper money, most nations employ special paper and other techniques to avoid counterfeiting. Interestingly, although coins are much harder to counterfeit, it costs more to make pennies and nickels than their actual face value. Paper money and coins are the most visible types of money, but there are many others. A checking account, also called a demand deposit, is money stored in an account that can be withdrawn without advance notice. One way to withdraw funds is by writing a check, written order, to financial institution to pay an indicated individual or business the amount specified from the funds on deposit. A legal instrument, checks serve as a substitute for currency and are preferred due to their low risk. A negotiable order of withdrawal account is an interest-bearing checking account. Savings account, also called time deposits, are funds in an interest-earning account that usually cannot be withdrawn without advance notice and or have limits on the number of withdrawals per period. They are not usually used for transactions. Money market accounts are similar to interest-bearing checking accounts, but with restrictions. Generally, in exchange for higher interest, the owner of the money market account can write only a limited number of checks each month, and there may be restrictions on the minimum amount of checks. Certificates of deposits are saving accounts that guarantee a depositor a set interest rate, but require the funds to be left in the financial institution for a specified period. If you withdraw funds early from a CD, you may be faced with a substantial financial penalty. Credit cards allow you to promise to pay at a later date by using a pre-approved line of credit granted by a bank or financial company. They are a popular substitute for cash because of their convenience, easy access, and acceptance around the world. Credit cards allow cardholders great flexibility in paying off their purchases. Credit cards may be issued by banks, travel and entertainment companies, and retail store chains. Credit card interest rates can be very high, and consumer credit card debt is a major cause of concern. Credit cards are one of the most expensive ways to borrow money. Reward cards are credit cards that carry benefits to the user. Many organizations such as Delta and ExxonMobil offer branded cards that award users points every time they use the card. These points can later be redeemed for rewards. The Card Accountability and Responsibility Disclosure Act of 2009 limits the ability of card companies to raise their interest rates, limits young adults' access to credit cards, and gives people more time to pay off bills, and made clearer due dates mandatory on statements. A debit card looks like a credit card but works like a check. The use of a debit card results in direct, immediate electronic payment from the cardholder's checking account to a merchant or third party. Traveler checks are money orders, and cashier checks are their other forms of near money that can be exchanged for cash or products. Credit card fraud. More and more computer hackers have managed to steal credit card information and either use the information for the internet purchases or making a card exactly the same as the one stolen. Losses on credit card theft run into the billions. Cryptocurrency. Bitcoin is the most popular example. It does have a fluctuating price and less desirable than fiat money. Does not have a stable value or portability. It's not favored by the governments because transactions are impossible to track, and it can be used for illegal transactions as well. The guardian of the American financial system is the Federal Reserve Board, established by Congress in 1913 as an independent government agency responsible for regulating the banking and financial industry. The Federal Reserve System is organized into 12 geographical regions. The Federal Reserve Board is the chief economic policy arm of the United States. It tries to create positive economic environment by low inflation, high levels of employment, balance in international payments, and long-term economic growth. The Federal Reserve Board has 5 major responsibilities: to control the money supply with monetary policies, to regulate financial institutions, to manage regional and national check clearing procedures, to supervise the federal deposit insurance of commercial banks belonging to the Federal Reserve, and to promote financial system stability. Monetary policy refers to the Fed's methods of controlling the amount of money available to the economy. Monetary policy is necessary to balance the supply of and demand for money to minimize economic fluctuation. The Fed fine-tunes the money supply with 4 basic tools. Open market operations are the buying and selling of the U.S. Treasury bills and other investments in the open market by the Federal Reserve Board. This tool is the most commonly employed. To expand the supply of the money, the Fed must buy securities. To decrease the supply of money, the Fed sells securities. The second major tool is the reserve requirement, which is the percentage of deposits that the Fed requires banks to hold in reserve. These cannot be loaned to businesses or individuals. Changes to reserve requirements will change how much banks will lend. Because the reserve requirement has such a powerful effect on money supply, the Fed does not change too often. The third tool is the discount rate. The interest rate the Federal Reserve charges for the money it lends to any banking institute meets the reserve requirements. The Fed is the lender of last resort to these institutions. When the Fed wants to expand money supply, it lowers the discount rate. When it wants to decrease the money supply, it raises the discount rate. Japan and Europe have been using negative interest rates since 2014. There has been no evidence that the negative interest rate has had the desired impact in Europe. The final tool available to the Fed is credit controls, the authority to establish and enforce credit rules for financial institutions and some private investors. The second responsibility of the Fed is to regulate member banking institutions. The Fed establishes and enforces banking rules that affect monetary policies and competition between banks. It determines which non-banking activities are appropriate and which should be prohibited among banks. The Fed can also approve or disapprove mergers between banks and the formation of bank holding companies. Surprise annual bank inspections are conducted by examiners. The Fed provides national check clearing for almost all checks drawn on a bank in one city and presented for deposit at a bank in a second city. The Fed also clears local checks. The Check Clearing for the 21st Century Act allows banks to clear checks electronically by presenting an electronic image of checks. Because of this, checks can be often processed within a day. Depository insurance. The Fed is responsible for supervising the federal insurance funds that protect the deposits of member institutions. Many banks are hybrids in that they perform two or more functions that were traditionally separated in banking industries of the past. Commercial banks are the largest and oldest of the financial institutions and rely mainly on checking and saving accounts as their major source of funds for loans to businesses and individuals. Banks today offer a number of services: consumer loans, credit cards, safe deposit boxes, trusts, and securities. Legislation permits commercial banks to offer insurance and investment banking products as well. This has placed U.S. banks on the same competitive footing as European banks. Banks are increasingly merging, and even across international borders. The most recent financial crisis and recession accelerated consolidation. High-risk banking and financial activities that contributed to the financial crisis caused the government to pass the Dodd-Frank Act. This act imposed two major regulations on banks. It raised the required capital banks had to hold on their balance sheet, and it limited the certain kinds of high-risk activities. Savings and loan associations are financial institutions that primarily offer savings accounts and make long-term loans for residential mortgages. S&Ls, also called thrifts, have undergone a metamorphosis in the recent years after having almost collapsed in the 1980s. Today, they compete directly with commercial banks by offering many of the same types of services. Many S&Ls merged with commercial banks. Credit unions are financial institutions owned and controlled by their depositors, who usually have a common employer, profession, trade group, or religion. At a credit union, a savings account is usually called a share account, while checking is usually called a shared draft account. Credit unions offer a wide variety of financial services comparable to commercial banks. Mutual savings banks are financial institutions similar to savings and loan associations, except they are owned by depositors. They are found in New England and are becoming more popular in other parts of the country, as some S&Ls have converted to mutual saving banks. The Federal Deposit Insurance Corporation was created in 1933 to provide an insurance fund that insures individual bank accounts. Should a member bank fail, its depositor can recover all their funds up to $250,000. Saving and loan association accounts were insured by the Federal Savings and Loan Insurance Corporation until it became insolvent with a large-scale thrift failures in 1980. It has since merged with the FDIC. The National Credit Union Association is an agency that regulates the charters, credit unions, and insures their deposits. These funds are intended to make people feel more secure about their savings so that they won't panic and withdraw them during a crisis. Their effectiveness seems to have been proven during many bank failures during the 1980s and 1990s. Large bank failures occur once again during the most recent recession. More than 474 banks have failed between 2009 and 2014. While the future may yet bring unfortunate surprises, many depositors go to sleep every night without worrying about the safety of their savings. Diversified firms. Recently, a number of traditionally non-financial firms have moved into the financial field, such as General Motors, Ford, General Electric. Many of these have been unsuccessful. It is best to stick with what you know. Insurance companies are businesses that protect their clients against financial losses and from certain specific risks in exchange for a fee. Pension funds are managed investments set aside by individuals, corporations, unions, and some nonprofit organizations to provide a retirement income for members. An individual retirement account, also known as an IRA, are a type of private pension fund set up by the individual to provide for their retirement needs. Taxes on the interest earned are deferred until withdrawn upon retirement. The Roth IRA is similar to a traditional IRA, but the interest is tax-free upon retirement because investors do not deduct their contributions at the time they are made. Most corporations provide some kind of pension plan for their employees. Social Security is the largest pension plan, is a public fund. The federal government collects Social Security funds from payroll taxes from employers and deducts them from the employee's paycheck. Mutual funds pull investors' funds and invest them in securities. Because of the large number of people investing in any one mutual fund, the fund can afford to invest in hundreds or thousands of securities at any one time, minimizing the risk of any single security that does not do well. Mutual funds provide professional financial management for people who lack the time or expertise to invest in particular securities. Money market funds invest in short-term debt securities issued by the government or large corporations. Exchange-traded funds, similar to mutual funds in that they invest in pool of assets. The difference is that the assets in the funds duplicate in stock market index, such as the Standard and Poor's 500 or the Dow Jones Industrials or the Russell 2000s. Brokerage firms and investment banks. Brokerage firms buy and sell stock and bonds for their customers and provide other financial services. Investment bankers underwrite new issues of securities for corporations, states, and municipalities. The new issue is called a primary market because the sale of securities is for the first time. After the first sale, the securities trade in the secondary markets by brokers. Finance companies are businesses that offer short-term loans at substantially higher rates of interest than banks. They are often a lender of last resort for individuals and businesses with less than stellar credit. Electronic funds transfer, also known as EFT, is a transfer of funds by means of an electronic terminal, telephone, computer, or magnetic strip. The most commonly used EFTs are the automatic teller machines, automated clearinghouse, and home banking systems. Automated teller machines, also known as ATMs, are the most familiar form of electronic banking and dispense cash, accept deposits, transfer funds from one account to another, and display a customer's account balance through portable machines accessed through ATM networks worldwide. Automated clearinghouses, also known as ACH, permits payments such as direct deposits or withdrawals to be made to and from a bank account by magnetic computer tape. AHCs permit direct deposits, now used by many companies and the federal government. The advantages of direct deposits for individuals include convenience, safety, and potential interest earnings. The advantages for businesses include decreased check processing expenses and increased employee productivity. Online banking gives customers access to a growing number of financial services. People can utilize banking services through home computers, laptops, PDAs, and smartphones. Increasingly sophisticated transactions can be carried out online. Computers and telecommunication technology have revolutionized world commerce. Consumers and small businesses can now make a bewilderingly array of financial transactions at home or go or on the go 24 hours a day. Computers and handheld devices have made online banking convenient. However, hackers have stolen millions from banking customers by tricking them into visiting websites and downloading malicious software that gives hackers access to their passwords. Rapid advances in technology are forcing banking industries to change. More services than ever are available electronically and online. The Fed response to crisis due to financial crisis began in 2007 and again with a crisis brought about by the COVID-19 pandemic in 2020. The Federal Reserve took unprecedented actions. Many large banks had shrinking capital base. The Troubled Assets Relief Program had to step in and buy up 250 billion of the senior preferred shares of bank securities. Most large banks either needed to take cash infusions from the U.S. Treasury or sell preferred stocks to the Treasury. The government didn't want to signal a financial community which banks were strong and which were weak to avoid panic. During this period, the Fed took up the unprecedented action of buying up troubled assets from banks and lending money at discount window to non-banks such as investment banks and brokers. The Fed also began paying interest on reserve banks kept at the Fed. The future of banking systems in the U.S. are in the hands of the U.S. Congress. The Dodd-Frank Wall Street Reform and the Consumer Protection Act was passed with the intent to eliminate the ability of banks to create this type of problem in the future. Shadow banking refers to companies performing banking functions of some sort that are not regulated by banking regulators. Peer-to-peer lenders like Prosper, a company that matches investors and borrowers with loans between $2,000 and $35,000. Other funding by internet websites such as GoFundMe and Kickstarter help people raise funds for things as diverse as healthcare issues to creative projects in arts, films, games, and music. Once again, thank you so much for listening to this lecture. If you have any questions about the content or the assignments, please reach out to me.